put your phone or device aside and immerse yourself in this audio story. Perfect for listening on the move, while relaxing, or for bedtime listening. We release new stories daily, so make sure to like and subscribe to not miss out. This story is based on true events. How Netflix swallowed Hollywood's last empire. On December 5th, 2025, at precisely 8:47 a.m. Eastern Time, a press release appeared on newswires that sent shockwaves through every boardroom, studio lot, and streaming war room in the global entertainment industry. Netflix, the company that began as a DVD by mail service and transformed into a streaming colossus, had done the unthinkable. It had agreed to acquire Warner Bros. Discovery's studio, film, television, and HBO Max operations for $82.7 billion, creating the largest entertainment monopoly in modern history. The transaction wasn't just a business deal. It was a corporate execution. The final dismantling of Hollywood's last independent major studio, orchestrated through a brutal bidding war that lasted barely 6 weeks and revealed the dark machinery of modern media consolidation. What makes this dark business story truly chilling isn't just the staggering price tag or the monopolistic implications. It's how quickly it happened, how savagely the battle was fought, and what it reveals about power, debt, and corporate predation in an industry supposedly built on creativity and art. This is the real-life business thriller about how Netflix conquered Hollywood, a corporate scandal unfolding in real time, and a financial mystery that begins with a simple, terrifying question. When did Warner Bros. Discovery realize they were prey, not partner? To understand how Warner Bros., the legendary studio that created Casablanca, The Matrix, Harry Potter, and Game of Thrones, ended up on the auction block in late 2025, you have to travel back to April 2022, when one of the most catastrophic mergers in media history was consummated. AT&T, drowning in debt and desperate to escape the entertainment business after a disastrous acquisition spree, spun off its Warner Media division to merge with Discovery Inc., creating Warner Bros. Discovery under CEO David Zaslav. The merger was sold to Wall Street as a content powerhouse that would compete with Netflix and Disney, a streaming giant with the combined libraries of HBO, Warner Bros., CNN, Discovery, and dozens of cable channels generating billions in cash flow. What investors got instead was a debt bomb ticking toward detonation. The merger created a company carrying over $50 billion in debt, a crushing financial burden that would define every decision, constrain every strategy, and ultimately seal Warner Bros. Discovery's fate before most executives even realized the game was already over. By December 2024, after nearly 3 years of brutal cost-cutting, content cancellations, and asset sales, Warner Bros. Discovery had managed to reduce that debt to approximately $40 billion. But the damage was irreversible. The company's stock had collapsed from its merger day price of around $25 per share to a devastating low of $7.52 in 2024, destroying tens of billions in shareholder value and signaling to Wall Street that Warner Bros. Discovery was no longer a growth story. It was a distressed asset waiting for liquidation. The numbers told a story of systematic deterioration that couldn't be spun away by quarterly earnings calls or optimistic projections. Revenue declined 4.84% in fiscal year 2024 to $39.32 billion, and the bleeding continued into 2025, with Q1 revenue dropping 9% to $9 billion. The company carried net debt of $34.6 billion at year-end 2024, generating approximately $1.86 billion in annual interest expenses, money that couldn't be invested in the content production necessary to compete with Netflix's $17 billion annual content budget. Warner Bros. Discovery was trapped in a death spiral. Too much debt to invest in streaming growth, declining linear television revenues as cord-cutting accelerated, and a stock price so depressed that raising equity capital would be catastrophically dilutive to existing shareholders. David Zaslav, the CEO tasked with solving this impossible equation, had spent 3 years implementing aggressive cost-cutting measures that earned him a reputation as one of Hollywood's most ruthless executives. Projects were cancelled mid-production. Tax write-offs were taken on finished films never released. Beloved HBO executives were forced out, and thousands of employees were laid off in waves of operational efficiency programs that prioritized debt reduction over creative ambition. The strategy succeeded in reducing debt by roughly $10 billion over 3 years, but at the cost of Warner Bros. Discovery's competitive position, employee morale, and Hollywood's faith in the company's creative vision. By mid-2025, even Zaslav recognized the endgame approaching. Warner Bros. Discovery couldn't survive independently, couldn't grow fast enough to outrun its debt burden, and couldn't compete with Netflix's scale advantages in a winner-take-most streaming market. In June 2025, Warner Bros. Discovery announced a strategic plan that was simultaneously admission of defeat and desperate attempt at survival. The company would split into 2 separately traded entities. Warner Bros., the good company, would house the film studio HBO and HBO Max streaming service. Discovery Global, the bad company, would contain CNN and the declining cable television networks that still generated cash flow, but represented a business model approaching extinction. The strategy was transparent. Separate the valuable entertainment assets from the dying cable business, allow investors to value them independently, and potentially attract acquirers interested in the crown jewels without the burden of legacy operations. Warner Bros. Discovery's stock rallied on the announcement, jumping from the $7 to $10 range toward $15 as Wall Street recognized that breakup value exceeded the conglomerate's depressed trading price. But the rally also sent a signal that Zaslav hadn't anticipated. If the parts were worth more than the whole, predators would come hunting. The first predator emerged in September 2025 from an unexpected direction. David Ellison's Paramount Skydance, a company that had only completed its own contentious merger 4 months earlier. Ellison, son of billionaire Oracle founder Larry Ellison, had spent 2025 orchestrating a controversial takeover of Paramount Global, backed by his father's billions, and leveraging close relationships with the incoming Trump administration to secure regulatory approval despite significant opposition. Before Warner Bros. Discovery's ink had dried on its spin-off announcement, Paramount submitted 3 consecutive unsolicited acquisition proposals, each rejected by Zaslav and the board as undervaluing the company. The final rejected bid came in at $23.50 per share, nearly double Warner Bros. Discovery's stock price just months earlier, but still insufficient in the board's estimation, given the strategic value of the Warner Bros. Brand and content library. But here's where the story transforms from business negotiation into corporate warfare. Ellison's aggressive pursuit had accomplished exactly what Warner Bros. Discovery feared most. It had officially put the company in play, signaling to every major media and technology company that Warner Bros. Was available for acquisition, vulnerable to hostile approaches, and potentially trading at distressed valuations that created once-in-a-generation buying opportunities. By rejecting Paramount's offers, but failing to secure alternative buyers or demonstrate independent viability, Zaslav had inadvertently triggered an auction process that would spiral beyond his control. In October 2025, Warner Bros. Discovery made the fatal decision that sealed its fate. The company formally announced it was exploring strategic alternatives, corporate euphemism for "we're for sale to the highest bidder." The auction attracted 3 primary bidders, each representing different visions for Warner Bros. Discovery's future, and each with dramatically different implications for Hollywood's competitive landscape. Paramount Skydance wanted to acquire the entire company. including the cable television networks, creating a traditional media giant that could theoretically compete with Disney through scale and Trump administration connections. Comcast, parent company of NBC Universal, proposed spinning off its own media assets to merge with Warner Brothers in a complex stock-heavy transaction that would create a jumbo legacy media company while allowing Comcast to exit direct entertainment operations. And Netflix, silent, strategic, predatory Netflix, submitted a bid for just the Warner Brothers studio, HBO, and HBO Max, leaving the cable networks to be spun off as originally planned. The first round of bids arrived on November 20th, 2025, with a December deadline for final offers, creating compressed timelines that favored buyers with pre-existing relationships and deep pockets. Paramount came in aggressively, reportedly offering around $27 per share for the entire company, and positioning itself as the Trump administration's preferred buyer. A claim backed by David Ellison's well-publicized attendance at White House dinners and close relationships with key administration officials. Netflix's initial bid was lower, around $27 per share for just the studio and streaming assets, but the offer was mostly cash rather than Paramount's combination of cash and stock, making it more attractive to Warner Brothers Discovery shareholders desperate for liquidity after years of stock price devastation. Comcast's proposal remained vague, focused on strategic rationale rather than specific pricing, suggesting NBC Universal's parent might be less serious about winning than positioning itself for alternative outcomes. Then the bidding war turned vicious. On December 1st, 2025, just days before second-round bids were due, Paramount's attorneys sent a 4,000-word letter to Warner Brothers Discovery's board, making explosive allegations that would dominate trade press headlines and reveal the savage nature of high-stakes M&A combat. The letter, obtained by multiple media outlets, accused Warner Brothers Discovery management of running a tilted and unfair process that favored Netflix from the outset, citing media reports suggesting chemistry between Zaslav and Netflix co-CEO Ted Sarandos that might influence board decisions. More damningly, Paramount claimed the sales process has been tainted by management conflicts, including certain members of management's potential personal interests in post-transaction roles and compensation as a result of the economic incentives embedded in recent amendments to employment arrangements. The allegation was explosive because it was partially accurate. Zaslav's compensation agreement had been restructured earlier in 2025 to account for potential sale scenarios, and Paramount had reportedly offered Zaslav a continuing role in a combined Paramount-Warner Bros. Entity, creating obvious questions about whether the CEO's personal financial interests aligned with shareholders' best interests. Paramount's letter also raised substantive antitrust arguments, claiming that Netflix's acquisition of HBO Max would create a streaming monopoly with over 30% market share, a threshold that DOJ guidelines traditionally considered presumptively problematic under antitrust law. The company argued that its own bid faced fewer regulatory hurdles because Paramount Plus and Warner Brothers Discovery streaming services were smaller players that wouldn't trigger the same competitive concerns as combining the number 1 and number 3 streaming services globally. But Paramount's aggressive tactics revealed desperation rather than strength. On December 4th, the day second-round bids were due, Paramount submitted another letter escalating its allegations, this time accusing Warner Brothers Discovery of active sabotage, based on a German newspaper report about WBD's international president meeting with EU regulators to allegedly raise concerns about Paramount's bid creating excessive media concentration. The letter concluded with barely disguised threat. Paramount has a credible basis to believe that the sales process has been tainted by management conflicts, and demanded the correspondence be shared and discussed with the full board of directors of WBD. It was corporate warfare conducted through lawyers and leaked to media, a public relations campaign designed to poison Netflix's bid while positioning Paramount as the wronged party, deserving regulatory sympathy. The strategy failed spectacularly. On the evening of December 4th, Bloomberg News reported that Netflix and Warner Bros. Discovery had entered exclusive negotiations, effectively ending the auction and crowning Netflix as the victor. Paramount's final bid had come in at $30 per share, all cash, with a $5 billion breakup fee. Financially superior to earlier offers, but insufficient to overcome Netflix's strategic advantages, and crucially, David Zaslav's apparent preference for a deal with the streaming giant that had transformed from DVD rental service to Hollywood's most powerful company. The announcement came Friday morning, December 5th, 2025, and the terms were staggering in their implications for Hollywood's future. Netflix would pay $27.75 per share for Warner Bros. Discovery studio and streaming operations, $23.25 in cash, and $4.50 in Netflix stock, valuing the equity at $72 billion. Including assumed debt, the total enterprise value reached $82.7 billion, making it one of the largest media acquisitions in history and dwarfing even Disney's $71 billion acquisition of 21st Century Fox assets in 2019. More critically, the deal included a $5.8 billion reverse breakup fee, meaning if regulators blocked the transaction, Netflix would pay Warner Bros. Discovery nearly $6 billion, essentially a billion-dollar insurance policy, guaranteeing shareholders would profit regardless of regulatory outcomes. It was a masterstroke of deal structuring that made rejection nearly impossible. Warner Bros. Discovery shareholders would receive immediate liquidity at prices more than double the stock's 52-week low, with downside protection if antitrust authorities intervened. But the most revealing details weren't in the press release. They were in what the deal revealed about David Zaslav's personal financial interests and the conflicted incentives that Paramount had accused him of harboring. According to financial data provider Equilar, Zaslav owned more than 4.2 million shares of Warner Bros. Discovery, with another 6.2 million shares in previously granted stock awards scheduled to vest, and approximately 4 million additional shares set to be delivered in January 2026, at Warner Bros. Discovery's pre-auction price of around $12.54 per share on September 10th, the day before Paramount's interest became public. Zaslav's total holdings were worth approximately $180 million, at Netflix's acquisition price of $27.75 per share. Those same holdings were worth approximately $660 million, a personal windfall of nearly $500 million created by the bidding war that Paramount had triggered, but Netflix had won. The optics were damning even if technically legal. The CEO tasked with maximizing shareholder value had personally gained hundreds of millions while presiding over a process that eliminated the company's independent existence and delivered Warner Bros. 102 years of Hollywood history to a technology company that had spent 15 years systematically disrupting and undermining the traditional studio business model. Zaslav's defenders argued he had fulfilled his fiduciary duty by securing the highest price available and protecting shareholders through the massive breakup fee. Critics noted that Netflix's offer, while financially attractive, posed far greater long-term risks to Hollywood's competitive ecosystem than Paramount's bid, and that Zaslav's personal relationship with Ted Sarandos and his own compensation structure may have influenced which risks the board chose to prioritize. The reaction from Hollywood was immediate, visceral, and uniformly negative across every stakeholder group, except shareholders celebrating their liquidity windfall. The Directors Guild of America issued a statement expressing concerns and announcing plans to meet with Netflix to better understand their vision for the future of the company. Diplomatic language concealing deep anxiety about Netflix's historically antagonistic relationship with theatrical exhibition and traditional Hollywood creative processes. Cinema United, the global theater exhibition trade association, was more direct. This deal poses an unprecedented threat to the global exhibition business, noting that Netflix's business model fundamentally opposes theatrical windows, and that Warner Brothers had been the top-grossing studio at the box office in 2024, generating hits like Sinners, a Minecraft movie, and Weapons, that would now be controlled by a company that views movie theaters as competitors rather than partners. The Writers Guild of America issued perhaps the most forceful condemnation. This merger must be blocked. A Netflix-Warner Brothers would create one massive media giant with control of close to half of the streaming market, threatening to force Americans into higher subscription prices and fewer choices over what and how they watch, while putting American workers at risk. The statement reflected deep-seated anxiety among Hollywood's creative community about consolidation reducing buyers for content, eliminating competition for talent, and empowering a single company to dictate terms to writers, directors, actors, and producers who would have nowhere else to take projects. If Netflix controlled both the dominant streaming platform and one of the two remaining major independent studios, Sony being the only other. Political opposition emerged with surprising bipartisan intensity, revealing that antitrust concerns transcend traditional partisan divisions when corporate power reaches monopolistic proportions. Democratic Senator Elizabeth Warren called the deal an anti-monopoly nightmare, stating that a Netflix-Warner Bros. Would create one massive media giant with control of close to half of the streaming market, threatening to force Americans into higher subscription prices and fewer choices over what and how they watch, while putting American workers at risk. Republican Senator Mike Lee declared the deal would raise more serious competition questions than any transaction I've seen in about a decade, while Republican Representative Darrell Issa had preemptively sent a letter to Trump administration officials in November, warning that combining Netflix and HBO Max would create a company with unequaled market power, exceeding the 30% threshold traditionally considered presumptively illegal under antitrust law. Perhaps most remarkably, the Trump administration, which had openly favored Paramount throughout the process due to Larry and David Ellison's close relationships with the president, reacted with what CNBC described as heavy skepticism, suggesting that even a pro-business, deregulation-oriented Republican administration recognized the monopolistic implications of allowing Netflix to acquire Hollywood's last truly independent major studio. The White House had reportedly held multiple meetings about the Warner Brothers Discovery auction, including at least one session with David Ellison himself, attempting to engineer an outcome that would deliver the assets to Trump-friendly Paramount rather than Netflix, which, despite Ted Sarandos's December 2024 dinner at Mar-a-Lago, had maintained more critical distance from the administration than other tech CEOs. The antitrust analysis reveals why this deal represents such a fundamental threat to media competition. Netflix commands approximately 8% of total U.S. television viewing time as of October 2025, according to Nielsen data, the largest share of any streaming service, and second only to YouTube's 12.9% when including all video platforms. HBO Max, Discovery Plus, and other Warner Brothers Discovery streaming services account for another 1.3% of viewing share. But viewing share dramatically understates Netflix's market power in the streaming subscription business, where it matters most. Netflix has surpassed 300 million global subscribers, while HBO Max reported 128 million global subscribers as of Q3 2025. Combined, Netflix Warner Brothers would control approximately 430 million paying subscribers globally, more than double Amazon Prime Video's estimated 200 million subscribers, and roughly equal to the combined subscriber base of Disney+, Hulu, ESPN+, Paramount+, Apple TV+, and Peacock. But the competitive harm extends beyond market share to market structure itself. Netflix's acquisition of Warner Bros. Would vertically integrate the world's dominant streaming distribution platform with one of the three remaining major content production studios, Disney and Sony being the others. This creates multiple mechanisms for competitive harm that traditional market share analysis fails to capture. Netflix could prioritize its own Warner Bros. Content over licensing deals with competing studios, reducing the content variety available to consumers. Netflix could withhold theatrical releases for Warner Bros. Films, accelerating the decline of movie theaters and eliminating the premium theatrical window that generates billions in revenue for studios and exhibition companies. Netflix could leverage its combined subscriber base and content library to demand price increases, knowing consumers have nowhere else to access. Game of Thrones, Harry Potter, DC Comics films, and Netflix's own original content portfolio, including Stranger Things, Bridgerton, and Squid Game. Most insidiously, Netflix could use its acquisition of Warner Bros. To train artificial intelligence systems on an unprecedented library of content spanning over a century of cinematic history, creating algorithmic advantages in content creation, recommendation systems, and production decisions that competing studios lacking similar data advantages couldn't possibly match. This data monopoly represents perhaps the most dangerous long-term competitive threat, transforming Hollywood from an industry driven by creative risk-taking and human intuition into an algorithmic optimization exercise where machine learning systems trained on Netflix's combined content library determine which stories get told, which creators get opportunities, and which audiences get served. Jason Kilar, former CEO of Hulu and Warner Media, who understands Hollywood's competitive dynamics as well as anyone in the industry, summarized the threat succinctly. If I was tasked with doing so, I could not think of a more effective way to reduce competition in Hollywood than selling WBD to Netflix. The potential Netflix/Warner Bros. Transaction is a consolidation that may serve the financial interests of shareholders of both companies, but which raises many serious questions about its impact on the future of the entertainment industry. Yet despite unanimous opposition from creative guilds, theater owners, policymakers across the political spectrum, and competition experts warning of monopolistic consolidation, Netflix expressed supreme confidence that the deal would receive regulatory approval within 12 to 18 months. On the investor call following the announcement, Ted Sarandos declared the company highly confident the transaction would clear regulatory review, describing it as pro-consumer, pro-innovation, pro-worker, pro-creator, pro-growth. Each claim disputed by the very constituencies supposedly benefiting from the deal. Netflix's confidence derives from several calculated advantages. The $5.8 billion breakup fee makes blocking the deal extremely expensive for regulators who know Warner Bros. Discovery shareholders will receive massive compensation if intervention occurs. The deal's structure, allowing the cable network's spin-off to proceed first, creates a more narrowly defined acquisition that may be easier to defend than buying the entire company. Most importantly, Netflix will argue that streaming isn't the relevant market for antitrust analysis, instead positioning itself as competing against all forms of video entertainment, including YouTube, TikTok, linear television, and theatrical exhibition. A definition so broad, it makes genuine monopoly power nearly impossible to prove under current antitrust frameworks. The European Union presents a potentially more serious obstacle, with competition regulators historically more willing to impose structural remedies or block deals outright when market concentration threatens consumer welfare. Antitrust experts interviewed by Deadline predicted the EU would likely approve the deal with conditions rather than blocking it entirely, potentially requiring Netflix to maintain existing licensing agreements with competing services, preserve theatrical release windows for Warner Bros. Films, or divest certain assets to maintain competition in European markets. But even these remedies would be temporary band-aids on a fundamentally monopolistic transaction, cosmetic concessions that wouldn't address the core problem of Netflix accumulating unprecedented power over both content production and distribution at global scale. For David Ellison and Paramount Skydance, the company that triggered this entire process through its aggressive September bids, the Netflix victory represents catastrophic strategic failure. Ellison had spent months courting Warner Bros. Discovery, publicly positioning Paramount as the Trump administration's preferred buyer, and promising to preserve both companies' identities while creating scale necessary to compete with streaming giants. Instead, his aggressive pursuit accomplished exactly the opposite of its intended effect. By forcing Warner Bros. Discovery into an auction, Ellison attracted Netflix, a far wealthier, more strategically dangerous bidder with deeper pockets and closer relationships with Zaslav, to enter the process and ultimately secure the prize. Paramount's final $30 per share bid was financially superior to Netflix's $27.75 offer. But Warner Bros. Discovery's board chose certainty of closing and compatibility with existing management over Paramount's higher price and uncertain regulatory path. Now Paramount faces a vastly more hostile competitive landscape. Instead of absorbing Warner Bros. To create a combined entity with scale and Trump administration protection, David Ellison must compete against a Netflix Warner Bros. Behemoth, controlling nearly half the streaming market, the largest content library in Hollywood history, and resources that dwarf anything Paramount can marshal. Sources close to the situation told CNBC that Paramount is considering taking an offer directly to Warner Bros. Discovery shareholders, a hostile takeover attempt, arguing that Paramount's deal faces fewer regulatory obstacles and serves long-term competitive interests better than Netflix's monopolistic consolidation. But such tactics require shareholder support that seems unlikely when Netflix is offering immediate liquidity at premium prices with a massive breakup fee protecting downside risk. The human cost of this transaction, the thousands of jobs that will be eliminated, the creative executives whose expertise will be deemed redundant, the institutional knowledge that will be discarded in integration processes, optimizing for efficiency over artistry, remains largely invisible in the financial coverage, celebrating deal-making prowess and shareholder windfalls. Netflix has made no public commitments regarding employment levels at Warner Bros., though company executives emphasize their intention to maintain Warner Bros.' current operations and build on its strengths. Industry analysts predict significant workforce reductions as Netflix eliminates duplicative functions, rationalizes content development processes, and applies its data-driven algorithmic approach to production decisions that Warner Bros. Traditionally made through executive intuition and creative relationships. The legendary Warner Bros. Studio lot in Burbank, where Humphrey Bogart filmed Casablanca, where Chuck Jones animated Looney Tunes, where Christopher Nolan shot his Dark Knight trilogy, will remain physically intact. But the creative culture that defined the studio for over a century faces systematic replacement by Netflix's algorithm-optimized content factory. Development executives who spent careers nurturing relationships with filmmakers will report to data analysts tracking engagement metrics. Projects that would have been greenlit based on creative merit and executive passion will instead be evaluated through predictive models forecasting subscriber retention impact. The transformation won't happen overnight, but it's inevitable once Netflix's systems and processes replace Warner Bros.' traditional Hollywood decision-making with Silicon Valley's quantified optimization mindset. The business lessons from this dark corporate thriller are as instructive as they are disturbing. First, debt isn't just a financial tool. It's a vulnerability that patient predators can exploit when market conditions shift and refinancing becomes impossible. Warner Bros. Discovery's $40 billion debt burden didn't cause its acquisition, but it created the conditions making independence unsustainable and auction inevitable. Second, in winner-take-most platform markets like streaming, scale advantages compound exponentially, making competition increasingly futile for smaller players lacking Netflix's subscriber base, content budget, and data infrastructure. Third, regulatory frameworks designed for industrial-age monopolies prove spectacularly inadequate for addressing platform-age market power, where dominance derives from network effects and data advantages rather than physical infrastructure control. Fourth, and perhaps most important, the streaming wars are over, and Netflix has won so decisively that the industry must now grapple with consequences of monopolistic consolidation: higher prices, less content diversity, fewer opportunities for creative risk-taking, and the replacement of Hollywood's century-old studio system with algorithmic content optimization, serving a single company's profit maximization goals. Disney will survive independently through its theme parks, merchandising empire, and irreplaceable IP library. But every other traditional media company now faces an impossible choice: sell to Netflix, Amazon, or Apple before your debt burden becomes fatal, or attempt competing against adversaries with limitless capital and structural advantages that make independent survival increasingly implausible. The most chilling aspect of this business scandal isn't the $82.7 billion price tag or even the monopolistic implications. It's how quickly Netflix achieved what seemed impossible just 5 years ago. In 2010, Time Warner CEO Jeff Bezos infamously dismissed Netflix as the Albanian army, asking rhetorically whether it would take over the world. 15 years later, Netflix has acquired the very studio Bezos once led, for a price exceeding Warner Bros.' entire market capitalization at multiple points in its history, consolidating power over Hollywood's creative output in ways that would have seemed dystopian science fiction when Reed Hastings first pitched investors on a DVD by mail subscription service. And somewhere in Los Gatos, California, in Netflix's gleaming headquarters, data scientists are already running algorithms on the combined content library, analyzing a century of Warner Bros. Films and HBO Prestige Television through machine learning systems that will determine which stories get told, which creators get opportunities, and which audiences get served in Hollywood's algorithmic future. The fortress hasn't just fallen. It's been occupied, reprogrammed, and transformed into a content factory optimized for subscriber retention metrics rather than the risky, ambitious human storytelling that once defined American cinema. The dark secret behind Netflix's triumph, the truth that transforms this acquisition from business deal to business thriller, is that systematic market domination often appears indistinguishable from innovation until competitors are already extinct and alternatives have vanished. Netflix didn't just buy Warner Bros. They eliminated Hollywood's last independent alternative to streaming monopoly, executed a corporate execution disguised as strategic partnership, and ensured that every remaining studio understands the implicit threat: compete with Netflix, and eventually you'll be consumed by Netflix. Your creative legacy reduced to algorithmic inputs, feeding the content optimization engine that has replaced Hollywood's century-old studio system with something fundamentally different and potentially far darker. December 5th, 2025 will be remembered as the day Hollywood's independence ended, not through creative failure or audience rejection, but through financial engineering, debt-driven vulnerability, and the cold calculation that monopolistic consolidation serves shareholder interests even when it devastates competitive markets, creative communities, and the very possibility of an entertainment industry. not controlled by a single algorithmic overlord, determining what stories humanity gets to see. The fortress didn't fall in battle. It was sold for parts while the board counted their windfalls, and the CEO calculated his personal fortune, and nobody with power to prevent the sale had sufficient incentive to ask whether some prices are simply too high to pay, even when the numbers look perfect on paper. Subscribe and listen to our next story below.